Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful. All time. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you get it. Yeah, but we all feel crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong. Come back tomorrow and lose it all. Should be fun.
Good morning, everybody. Wow, I was a little slow on the draw. Oh, you know what? Here our stream is messed up. I didn't make it public. I really hate that it does that. Like, why would I ever want to run a private stream? It's just silly. Let me refresh that. Make sure we get this thing going here. Okay, so coming back, it must be summer. Usually we have more people at the very beginning, but you know, it's kind of summer. It's been starting slow. So let's go to the charts real quick. I'm a little behind on the news and everything, so I will read that a little bit later here. It looks like we gave up all of our gains overnight. The treasuries are seeing a flight to safety bid. It was a little choppy yesterday. I was actually like, you know, a lot of the analysis that I was reading last night was like, oh, you know, yields rose and all this, but look at that overnight. Okay. Ooh. Okay. So oil taking the hit here too, huh? And gold and silver bid. Kappa not looking good. So I'm seeing a global growth, flight to safety sort of trade here. So then, okay, so the dollar, well, that's interesting. So the dollar is not being bid super strongly, at least not yet. And Bitcoin, looks like they had another breach of 20,000 overnight. Let's see, here is the 22nd, right? Yeah. All right. So, gonna put that there. So let's come back here. I'm gonna come and read the news. News squawker. What is it? It's a Wednesday. We do have some Canadian numbers today, right? Yes. Bank of Canada core CPI. Month over month, no estimate, but the previous reading was 0.7. Okay. Where's my /blog? Yeah, there we go. Oh, I'm gonna sneeze. We've had a little sickness come through. Yeah. Sentiment subdued with commodities curtailed ahead of Powell and Biden. Man, I got the sneezes today. Okay, so that's right. We are going to have Chairman Powell testifying at 7:30. So when the market opens, well, that's never fun. I hate that kind of stuff because like usually he doesn't say anything significant at congressional hearings like that, but it does affect the markets. Bonds browse on broader risk sentiment through bonds fade somewhat post issuance. Oh, we got Evans and Harker speaking today as well. Russian Defense Ministry says they have agreed with Turkey to continue consultations on safe vessel departures and grain exports from Ukraine. Kremlin says it's still working on retaliatory sanctions against Lithuania after it imposed a ban on transit of some goods. Okay, so that's good. Actually, that's actually good because what I'm worried about over there is that they just decide to attack Lithuania. Israel's parliament votes to disband. Guino says he expects inflation to ease after the summer, but stay near current levels in the coming months. Governing Council is yet to discuss details of an anti-fragmentation tool. New tool should be different from the prior OMT tool as circumstances are different. Energy sectors are laggards in Europe. Ant Group is reportedly to apply as soon as this month for a key financial license, citing via Bloomberg, citing sources. Okay, that's significant. Yen is also in demand as a safe haven as sentiment sours. Global inflation and recession concerns. U.S. President Biden will deliver remarks on gas prices around 1400 EDT on Wednesday and will call on Congress to implement a suspension of the federal fuel. You gotta be fucking kidding me, man. We'll talk about Biden here today, man. It's just, this is really starting to grind my gears. Multiple Democrat sources said that the effort to suspend the federal gas tax for 3 months stands almost no chance of passing, according to Politico. IEA warns Europe to prepare for a complete shutdown of Russian gas exports and that government should keep aging nuclear plants open and take other contingency measures, according to the Financial Times. Spot gold is in line with other metals, yes. Johnson is of the view that the government must win its battle with the rail unions and is prepared for the standoff to last months, according to the Times. I was not aware that was a thing. Okay, hold on. Yellen says she believes there's a path to bringing down inflation while maintaining a strong labor market. Yellen also stated that the traditional recession measure of 2 consecutive quarters of negative growth has typically worked, but recessions aren't alike, and that most economists do not believe the U.S. will enter a recession because they are taking into account post-pandemic economic features. White House economic advisor Borshi said she remains optimistic that the U.S. can avoid a recession and responded that U.S. President Biden is considering anything he can to lower prices when asked if Biden will cut tariffs on Chinese imports. Okay, so nothing too significant. So there's not like any like key piece of news or anything like that going on to explain the change here, but it does look like an overall, just like what we're seeing with the correlations and so forth, an overall flight to safety, global growth kind of bearishness. Fed paper finds elevated probability of recession. Paper finds slightly more than 50% chance of a recession over the next 4 quarters and a 2/3 probability of a downturn over the next 2 years. Ouch. How on May 17th? Restoring price stability is an unconditional need. It is something we have to do. Monetary Policy Report on June 17th. The committee's commitment to restoring price stability, which is necessary for sustaining a strong labor market, is unconditional. Yes, okay. So they're sticking that reminder that cash is up 22% on the year versus financial assets, and of course 135% versus Bitcoin. Wow. The equivalent of 60% of GDP has been wiped out from U.S. bonds and equities markets alone in the last 8 months. It's the biggest financial drawdown as percent of GDP ever experienced over the last 40 years. Yeah. Well, but that was because they had injected an unprecedented amount of liquidity into the economy. It's not necessarily a loss per se, because we never had the gain. With Bitcoiners, COVID pass, Trumpo barbarians, politicians, etc., conclusions are invariant to information, but reasoning and methods change. In science, scholarship, business, and trading, conclusions change with information, but the method stays the same. Okay. In other words, learn to identify those who are rationalizers but not rational from those who are rational but not rationalizers. That doesn't really help the... I don't know. I have to say, yesterday, Taleb tweeted a paper that was interesting, but he was making conclusions about that paper that were not supported by the paper, frankly. So I think that he is a little bit in denial about where he himself is irrational on certain points. All right. Well, hey, NASDAQ killer, you're here on time today. I don't know. I'm kind of feeling like we might just have a slow day. I was up late. Well, not up late, but like the babies, both of them were crying like all night, so I did not sleep very well. I kind of just feel like ranting about Biden's and terrible energy policy. Came early from work. Oh, I hope everything's okay. That's hindsighting because everyone agreed with the Fed when they injected all that money. You can't give up on those ideas and now blame the Fed after it didn't work. Well, but it's not that. Like, here's the thing, okay? Well, you got to remember how this all works, right? When you have an economic crisis going on, you inject money into the economy in order to spur growth. Excuse me, in order to start some growth. And then as we grow, we take that money out of the economy, right? That's how it works. What happened this last pandemic was we injected an insane amount of money into the economy. It was just like, how much can we actually put in there? They didn't make any effort to say, what is the appropriate amount of liquidity that we need in the economy according to our needs and the economic catastrophe that actually happened? Nah, it wasn't that. It was like, well, we're just going to buy everything. Oh, and Congress, you need to buy everything too. They injected as much money as they could, right? And then they let that money run wild for 2 years. The indexes like doubled or whatever it was, right? And they never stopped for a second and said, well, maybe we should pull some of that liquidity out. Right? It's a little silly when you think about it from that perspective, right? So, yeah, but they put in too much, so they pulled some of it out. So when that money comes out, yeah, it is a drawdown in like the value of assets, but that ignores the huge pump that we had before that was not really justified by the fundamentals. It was only a distortion created by excessive monetary stimulus. That distortion can spur growth, but eventually you have to pay for it, right? And because we did it too much when it came time to pay for it, it was a little ugly. Have we bottomed yet? I don't know about that. So what we saw yesterday was definitely a short coverage rally, right? One that we predicted really well. So feeling pretty proud about that one. But overnight, they gave up practically all of those gains. And not only did we give up those gains, but I'm seeing like real flight to safety kinds of behaviors across assets this morning. The treasuries are basically the only thing that is up. Right? So, man, That 4 nights rest did not help my slight cold. Anyways, so, you know, in my TikTok video yesterday, I said, well, looks like short covering rally, but all reversals, major reversals start that way, right? But I think this overnight action kind of suggests that, nope, it was just a short covering rally and there's nothing more to come from it than that. But at the same time, I don't see any key changes or headlines, anything like that. It's just like all of the sudden they decided to sell last night for whatever reason. The sentiment changed, which means that the sentiment could change and be positive probably just as easily. I don't see like a significant amount of news today, but Chairman Powell will be testifying in front of Congress today and tomorrow. So there's that. Mohammed A. El Arain. This semi-annual congressional hearings today and tomorrow, the Federal Reserve Chair will face questions on both sides of this policy dilemma. While markets are expecting him to come across as strongly anti-inflation, the extent of the hawkishness will be closely watched. Yeah, the thing I hate about this is I don't think that he's going to say anything new, but probably will get major moves in the treasuries anyways. Okay, oh, it's time for me to roll over Bitcoin. Oh, and you know what? I don't have... Okay, so I have a couple of instruments missing from my list. So let's add them. 6J, Japanese yen, and we'll do 6E. And we'll do... let's do all of them. British pound. 6, and then what's the other one? Swiss franc, 6S. I guess I could put the Canadian dollar up there, but I don't know if I really care. Fine, we'll do it. I said it, now I have to do it, right? Do I have on here soybeans? Yes, I do. Soybeans, corn. Apply. There we go. And that should fix our DOM over here. Okay, good deal. I would venture to say that the current crash is actually caused by increasing interest rates of the Fed rather than... I don't know if I agree with that. I mean, it's one factor, right? Although it is their job, it's not as significant or impactful as they think. Well, but it's not just the raising rates. You notice there's always this odd push and pull. Well, that's a really interesting behavior going on there in the Treasury. Am I missing something here? Hold on a second. I think that them draining liquidity out of the market is pretty significant to begin with, right? But raising interest rates is a small part of that, right? Well, I'm not seeing any news. I think that the treasuries are just going off on themselves. Fed sees elevated risk of recession over next 4 quarters on the Wall Street Journal. So that is them, the Wall Street Journal, picking up on that internal Fed survey. That I'm wondering if that ends up being like the key news headline today is that study by the Fed. Well, we probably should read it, huh? Because I want to know, what are they doing differently in that suggests this? No, here's the thing, is that we we're expecting to see a slight slowdown in the late first quarter, early second quarter. Squawk saying something. It scared me because I could hear like typing in the background or something, and I thought that somebody was opening the door. Anyways, we were expecting to see some weakness earlier in the year, right? And then the whole Ukraine thing happened. So that really hurt the markets, I think. And then on top of that, inflation came in, and inflation was very harmful to the markets. And then the Federal Reserve had to come in and raise interest rates, and that was harmful for the markets. So I think that really what you got is a very strong confluence of a lot of bad things happening all at the same time. The thing that is alarming to me is that we're down like 20%, and people are still kind of saying, oh, okay, well, we might have a recession next year, or, in the next 4 quarters, let's say. Okay. In the next 4 quarters, we might have a recession. Okay. So if we're not actually like in the recession yet, then that means that we're not even halfway down, right? From that perspective, we're not even, this bear market is just getting started. If that's really the case, right? That's what's kind of alarming about it. And how much of that is actually priced in by the markets? I don't know, man. Well, the treasuries sure took off there, didn't they? I'm quite surprised. Are we they're headed to 3 again. Man, if we see 3% this week, that's going to be like, what? Banks need to learn how to diversify out of the real estate sector. Do you have any data about how much of the real estate sector they're exposed to as a percentage of their assets and so forth? I don't know. It's kind of interesting, the real estate sector, because we were definitely, I think that if you were looking for signs that we put too much liquidity in the markets, seeing the bubble that we created in the real estate market is probably the best place to see it, right? But we have a real supply shortage in real estate. So I don't know if that market is actually going to come back all that much. Like, so far, we've seen activity slow down a lot, but the prices really haven't changed that much. Like, it's gone from you had to have 20 offers the day that you listed to now you have two, right? But the house still sells for more than you were expecting. At least that's how it's going here in Utah. Well, that treasury came back into that hole awfully quickly. 65. Well, of course. Well, no. I think that stat that you're getting might be a little bit too flavored by like where you're looking at it from, right? Because if you're talking about like Citi or Wells Fargo or whatever, 65% of loans are given to buy houses, of course. But that doesn't really tell you about what the rest of the banking sector is doing. That doesn't tell you like what JP Morgan and Goldman Sachs are doing, right? It's very different. The sections, you got to remember that there's sections of the banking market that are focused more towards retail, and there are sections of the market that are focused more towards small business and corporations. I just keep seeing people when all of the news people are coming in today whoa, what are we going to tweet about? They're all talking about this recession paper. Let's see if I can find it. Fed study recession. So if I search Google for it. Recessions impose sizable hardship with large increases in the unemployment rate and related dislocations. In addition, recessions can lead to large shifts in financial markets. As a result, economists and financial market professionals have considered prediction models to assess the probability of a recession. Let me make sure before I start reading this to y'all. What okay, I think this is the study, okay? This note highlights the implications of these approaches to assessing recession risk. The risk of a recession is akin to the risk of a sizable increase in the unemployment rate. In light of this correspondence, our empirical approach focuses on the risk of a sizable increase in the unemployment rate. Specifically, the empirical analysis considers models of the probability that the change in the unemployment rate over the given horizon H, conditioned on period T information, exceeds the 80th percentile of the unconditional distribution of changes in the unemployment rate. Okay, so they're saying that their model's prediction of how much employment could change is larger than how much the unemployment rate tends to change on its own anyways. Okay. And there's a bunch of math there. At a horizon of 4 quarters, the 80th percentile of the change in the unemployment rate for data from 1965 to 2019 equals 3/4 of a percentage point. That's not that much. Okay. Changes in the unemployment rate at these horizons of this magnitude are always associated with recessions. This mapping is intuitive. The defined range, large increase in the unemployment rate, has a 20% probability unconditionally, and the frequency of recessions is in this neighborhood, i.e. 7 recessions in the 55 years period between 1965 and 2019. The biggest deals are given at the lowest rates for the biggest real estate owners because it gives the appearance of lower risk for the bank one. In reality, it's maximum risk because I don't see how it's maximum risk. They are only invested in stones instead of, say, food or innovation. Nah, I don't. I can see where you're trying to pull from, but I don't think that that's accurate. So, an investment, when you want to invest in something, yeah, you want to invest in something that actually yields things, right? I would rather have an asset that is productive today rather than an asset that, is only going to produce after 5 years of investment, which is the case for a lot of techs, right? They're still unprofitable. But there's also like the amount of risk involved, right? How likely is that thing to produce for you, right? So for instance, with a treasury, there is very, very little risk. That treasury will pay you back a certain amount. It's just that the amount that it pays you back isn't really much after you account for inflation, for instance, right? So does a house provide much of a return for you? Well, it doesn't produce something. So in some respects, you can consider it a liability, right? But there aren't many houses. People always need to have houses, right? And so the chances of the value of your house going up over time is quite high, at least in the current environment. There could be things that could change about that, but in the current environment, it's a very high probability that the chances your house will continue to grow. Great example, here is that in 2008, yeah, we had a huge crash in the real estate market and everything, but prices, declined for like a year, and then they chugged on and are much higher now today, for instance, right? So like that's like the worst case scenario you got. So it is low risk for the bank. But what happened in 2008 was that all of the banks dumping into that low risk asset kind of created a systemic risk, right? So when we had the short temporary decline in housing prices, it led to financial crises. The financial system is very different today. I don't think that you would see a financial crisis amongst banks because of declining house prices. Anyways, I digress. Back to the study. The empirical approach to gauging time variation in this measure of unemployment risk is drawn from the literature on predicting recessions. In particular, I estimate a logistic... Why is it I? Who is I? Michael T. Kiley. I don't know who that is. Bum 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 ba-dum ba-dum bum. Okay. A common approach to assessment of recession risk uses financial variables such as the credit spread. Here, the difference between the BAA corporate bond yield and the 10-year treasury yield, and the term spread. Here, the difference between the 10-year treasury yield and the federal funds rate. Well, that right there, I'm already seeing problems with this approach because there's all sorts of distortions in the treasury markets, right? So I question the ability of what we're seeing in the treasury market today to effectively predict a recession. All right, well, whatever. Estimation of a logistic model to predict a large increase in the unemployment rate over the next 4 quarters using only the credit spread and term spread yields the predicted probabilities in the figure 2. The probability of a large increase in the unemployment rate over the subsequent year implied by this approach as of the end of March 2022 is low, about 5%. The event under study is an increase in the unemployment rate that has a 20% probability unconditionally. This suggests the risk of a recession over the following year, in the year following March 2022, is below average. Okay. Another approach to assessing recession risk considers leading identifiers identified by economists. As an example of this approach, I use the variables from the previous model, credit and term spreads, and add the change in the OECD's composite leading indicator. Okay, so now we're talking real shit. This leading indicator is a summary index of consumer confidence, business confidence, production, and labor market indicators and financial variables, including the term spread. The probability of a recession over the next 4 quarters from this estimated model is reported in figure 2 and is quite low as of March 2022, about 5%. Huh. While this exercise is illustrative of an approach using leading indicators, the related literature uses slightly different approaches. For example, leading indicators other than that produced by the OECD or methods that look directly at the underlying indicators that enter a leading indicator, for example, Burge, follows the later approach. In their analysis, Burge considers a set of individual indicators that include the consumer confidence, business confidence, production, and labor market indicators and financial variables that enter typical leading indicators and then combines their recession predictions using a statistical procedure, Bayesian model averaging, that applies a higher weight to good predictors. Despite the differences between the approach of Burge and the simpler approach using the composite leading indicator illustrated in figure 3, key aspects of the approaches are similar. In particular, these composite indicator approaches tend to be useful for predicting recessions at short horizons, but less useful at horizons beyond 12 months. And they are above 116.30 with a large bid there. Well, I'm kind of looking at this and having it moved like that. I'm kind of sitting here like, well, maybe you should have done something. But there's been some nasty pullbacks, so I'm still kind of sitting here like a little uncertain why they're doing what they're doing. But I do have to say that the volume, the push here in the treasuries is quite strong. We definitely would prefer to go long here, wouldn't we? Oh, geez. Yeah, that's so. Okay. I haven't seen it play out like that in a long time. Came up to the big stack, put a big bid below it. All of the orders just blast through. Look at that. I should have taken a live trade there. It was would have been an easy $10. Looks like they might fall into a hole here though. That was a lot of volume that just went off. Like holy crap. Okay. Recession risk using inflation and the state of the business cycle. As of March 2022, inflation was at a multi-decade highs and the unemployment rate was near multi-decade lows. Considering the ability of the level of inflation and the unemployment rate in conjunction with financial variables to predict large increases in the unemployment rate, focusing on horizons of a year or more following the approach in that research, a model with 4 variables is considered: CPI inflation, the unemployment rate, the credit spread, and the term spread. Figure 4 reports the probability of a recession over the next 4 quarters from this approach. This approach implies a sizable risk above 50% of a large increase in the unemployment rate over the next 4 quarters. Historically, elevated inflation and low unemployment have preceded recessions, consistent with the idea that such developments signal imbalances that may unwind through an economic contraction. Okay. Highlights how the unemployment rate and inflation are stronger predictors of recession risk relative to financial variables over horizons longer than 4 quarters. To illustrate the implications of that finding for the current level of recession risk, Figure 5 presents the probability of an increase in the unemployment rate that exceeds its 80th percentile over the subsequent 8 quarters from the same approach. The approach applies a more sizable risk of large increase in the unemployment rate of about 67% over the next 2 years. Finally, one notable aspect of the results in Figures 4 and 5 is the effect that the inclusion of the unemployment rate and inflation have on the predictive role of the term spread. In particular, inclusion of the unemployment rate and inflation lowered the predictive role of the term spread, which contributes to the large risk of recession associated with these regressions. Conclusion. The analysis herein highlights how financial leading indicator and other macroeconomic variables provide different signals regarding the risk of a recession. For example, the term spread does not suggest much risk of a recession over the near future, while the low level of unemployment and high level of inflation suggest a higher risk of a recession over the next year or two. Notably, a prediction model that includes the unemployment rate and inflation rate in addition to the term spread substantially lowers the role of the term spread in predicting recessions at 1 or 2 year horizons, suggesting that some of the predictive power of the term spread stems from the correlation of the term spread with the business cycle. In other words, probably term spread is unlikely to be useful in this situation, right? The differences across the approaches highlight the need for additional research. For example, the approach that combines inflation, unemployment, the credit spread, and the term spread nests the approach that only looks at the credit spread and the term spread. This nesting would imply that the larger model is superior if the sample of data is sufficiently large to provide reliable results. As highlighted in the figures, the sample period only includes 7 episodes of large increases in unemployment, and econometric analysis with such limited historical experience is a challenge. There they go again. Notably, all results herein are based on an estimation over the full sample period and do not reflect real-time estimates or predictors. Gotcha. Okay, so what I am getting from this? Oh, Fed's Harker is saying something. Harker is doing an interview here, and it sounds like he is saying, I don't know. I am not. This is really interesting. So I think I'm just going to sit here and watch it. This is incredibly interesting. Something big here is going on. I think I have no clue what it is, but there is just a really strong bid came through the treasury market here. There is a possibility that that was the high right there. I should point out there is a possibility that that was the high right there. It does look like that large meta order that was pushing up is probably done with that leg at least. Okay, so it could reverse here, or it could be a short-term pullback, and we kind of balance around 117 again for a little while before they make another push. But since I don't know what's driving this, Feds Harker is speaking at the moment, but what he is saying is more about how they're raising interest rates and that they're getting the response that they want. And he's saying we're going to be above 3% before the end of the year. Right now we're at 3.161. So why would we be selling aggressively at 3.16? Right? That doesn't make any sense. So I don't think that it has anything to do with what Feds Harker is saying. Powell is speaking later today. I wonder if maybe his comments have leaked or something. This has like there's a piece of information out there that we don't have. It's screaming that very, very loudly to me at the moment. Part of me wants to say, this could just be traders trading, but the volume that happened there at 117, that was not just traders trading, right? Somebody was there to buy and they ripped right through them. Of course, some market makers probably are making a little bit more of money off of that. Like you could have gotten filled at 117, and if you were able to hold through all of that, you could be taking it off down here. Feds Harker, we could have a couple of negative GDP quarters. Also, technically breaking swing trend today. Let's see if I'm getting what he's saying. Nick Timiros. Timiros. I don't. How do you say his name? Timiros. 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 Nick Timiros. Mortgage purchase applications were down 10% from a year ago. Of note, the average loan size at just over 420,000 is well below its 460,000 at peak earlier this year and is potentially a sign that home price growth is moderating. Well, you wouldn't get very much for 460 today. In Utah, at least. I don't know. We are getting we're at some key inflection points in the chart. So Alligator was saying this is a change in the trend. So I went in and drew a trend line. Not that trend lines matter or are predictive of anything, but he is right. We have had kind of like a downtrend that's been going on for a few weeks, and we are like kind of breaking that. I'm just going to delete that because, I don't know. I don't really like taking that kind of an approach. When we come and we look at like the larger chart, there's been some like extreme volatility in through here. So I'm thinking that what would be more likely or what would make more sense is some sort of recovery. So this, you know what? I don't have this marked, but this was the CPI, right? Event. Let's see here. I'll put it right there. Crazy CPI. That was June 10th, right? I'm pretty sure that that's what that was, but this week. Yes, it was on the 10th. So there was the crazy CPI on the Friday. Then the sell-off that came through the next days. So we may be seeing a retracement of the crazy CPI. Something like that, like the market saying that the CPI was the point at which we went too far, and that reading was an outlier, and that growth is moderating from here, and that the Federal Reserves will, in the end, back off of raising interest rates. that could be the move that we're seeing right now. And so if you were to see this move continue, then you would want to see perhaps a continued increase up to 118. Not that I'm saying that would happen today, but that would be like the longer term goal for that trade, right? Fed's Harker, if demand softens, 50 basis points for July may be good. Not ready to decide on 50 or 75 for the July 27th meeting. Evercore ISI's take on the gas tax holiday. Taking 4 months to consider a policy is one thing. Taking 4 months to decide on a talking point is another. We take this as a bad sign about the White House policy process, with delays likely to continue. But their headline is Biden's gas tax holiday is a sign that the quiver is empty. Okay. So there's a theory to consider. Is the Biden administration's decision to try and go ahead with a gas tax holiday, which they predict has a 0 chance of passing, suggest that there is a hard cap on the market and that inflation is likely to decline from here? I don't know. That's a crazy theory. 20,000 that has traded at 30 now. Was it yesterday we were at 1? Yeah, we were at 115.30. Jeez. So overnight up a whole point. Oh, the plural of crisis is crises. No, is I don't know how it's spelled, Salim. I'd have to look that up. Well, I feel awfully left out. I know what you're thinking. You're thinking, I should have taken a trade. Maybe I should take a trade right now. I would really like to click something. I know. You know what? Because clicking things is really fun. Clicking things is really, really fun. But sometimes you click on your DOM, and if you don't know what's going on, you're likely to lose money. And especially in a market like this, you could lose a lot of money very quickly, right? So instead of clicking on the DOM, why don't you go and click that like button? And that'll probably satiate you for at least a while. And then if you feel the need again, you can unlike it and then re-like it again. Yes, I read that. Not meaningful right now. It should sustain activity in oil prices, but CL's plunging. Is true. So the bearishness could be that people think that Biden's energy policy is a bust, that it's not going to change anytime soon, and that's bad for the economy. But if that's the case, why would oil sell off so hard? There are plenty of taxes, breaks, cuts, holidays in euro, and it doesn't help much. Yeah. But why would that decrease oil and demand in oil? I don't know. Because it like the market seems to be screaming to me all of the sudden that they see some huge inflationary risk coming into the market at the moment. That's what they seem to be saying. And it's just a little bizarre that it's just like all of the sudden that they've decided that, you know? Thanks for your latest video on Gamma. Well, thank you. It's doing really well. And it's something that we've talked about a lot. You know what I'm kind of realizing with that video is that, well, I mean, I'm realizing this all the time, but it often seems like there are things that I just seem to understand. And sometimes it's not even that I understand it. It's like there seems to be these situations where I know what it means and what direction things are going to move based off of it, but I couldn't necessarily explain to you how to come to that conclusion, right? Like with the gamma thing, the thing that I don't know explicitly is how would you go and look at all of the option trades in the market and use that to calculate what the current market's gamma positioning is, right? I don't know how to do that. I rely on Spot Gamma and these other guys on how to do that. And yet I still seem to know when I read those notes what's going to happen. You know what I mean? And so it's interesting to watch people's reaction to this video and the questions that we're getting on on the gamma video to see these places where there's things that like people are having a hard time understanding, and then I'm like, oh, but I don't actually know how to explain it to them. Like one of the things is that people are like, okay, but how do you know that that's what's going to happen? Well, I only know because of what Spot Gamma says. Spot Gamma says they were long gamma. Long gamma means that they're going to be constrained. So, anyways, the point is, leave comments on that video about what you don't understand, and so that we can figure out what the next video on this subject we should make. Because it sounds to me like you guys are really, really interested in this. It's kind of surprising to me. I guess it's a part of it is because people can see so clearly that it matters, right? Like it's really, really clear last options expiration and the options expiration that we had just last week that this has a very dramatic impact on the markets, and that if you're going to be trading equity indexes that you have to be following it. It's very, very obvious for people to see that. So there's going to be a lot of interest in it. I think that we should make more videos about it. It's a global energy shock at the worst time at recovery in the business cycle, and there's no escape. We must swallow it until productivity gains allow us to live with it. Before that point, can only depress activity. Government measures are only good at saving the biz at shock time. Yeah. Will FOMC be significant in 5 minutes now? Okay, so what that is, Nasdaq killer. Well, maybe were we talking about this since you've been here? I don't know. Anyways, it's not FOMC. It's the Federal Reserve President will be speaking to Congress. Okay, when Powell speaks, especially to Congress, he really tries his hardest to not make any market moving headlines. Okay, but the market watches what he says very, very closely. So it is very likely that we will get, so I would treat the rest of the afternoon, really. I would treat this market as you would the FOMC press conference was happening. It's the same sort of thing. There's a live Fed speaker going on right now. You don't know what he's going to say, and the market could react very adversely to whatever it is that he says. So in that situation, I probably don't want to be holding a position, right? Because that position could go against you so quickly. Maybe if he says something really significant that we think that we could just trend all day off of, then maybe we can take a trade. So we sit and watch our news squawk really carefully. But I probably don't want to be holding a position, right? Because we don't know what he's going to say. Maybe some people are betting on what he's going to say. That's one of our theories. I think we've got about 3 theories right now, right? One theory is that they're front running whatever Powell is going to say. One theory is that a Biden administration's ineptitude on oil policy is coming to a head, and that the market foresees a deflationary impact in the long run from the higher oil prices. That is just going to hurt the economy too much, and then we're going to have rolling blackouts, etc. And the other theory that we've got going on is that it could just be a break of a larger trend. It is possible, given the volume that we've seen, that it could have been a breakout, and even a Vaults breakout, for instance. Ari Biden, there's no escape, to be honest. The thing he could do is about energy licenses, permits, open bar plus use it or lose it, unleash economic forces. Yeah, I don't. There's certainly a lot of things that he could do that would improve sentiment around it, but a lot of the things that he could do are things that should have been done a long time ago. Yeah. Oh, thanks. Yep. You're welcome. You're welcome. I really hate it when he's talking to Congress, because I can't think of a single time where something useful came out of Chairman Powell talking to Congress, but it always affects the market. I wouldn't say that I can never think of a time where there was like a really solid trade to take off of his comments from him speaking to Congress either, but you definitely get volatility. Like I'm telling you, this thing is going to get slippery here. So, S&P 500 is kind of starting to get a little fidgety here ahead of the open. Let's just take inventory here a little bit. Bitcoin was pressured a little bit earlier, but for now, they've come back up to the higher end of their range. Gold and silver still looking pretty strong here. Copper possibly reversing higher. It's actually broken out of its range down here. The 6J is kind of following the Treasury. And now more recently in the last 5 minutes has pushed a little bit lower while the Treasuries have stayed in the range. So a little bit of divergence there with the 6J, but not with the dollar. They seem to be in lockstep with the dollar, generally speaking. Most active thing I see on my list right now is the NQ. There's quite a lot of activity in the equities. Also, oil very active this morning. And again, oil has been selling off basically all night. And they're coming down to 102. They trade his eye twitches, implied meaning. That's exactly what it is, right? Oil biz can be very reactive when they see greenbacks. Remember how fast they ramped up drilling a few years ago? Okay. Well, here's the open. Well, that initial move is a sell, but so here's the initial comments from the Fed president. Okay, so I don't hear anything in Powell's opening statement. Is this going to retrace this whole move? Oh, this is getting interesting, right? But look, hardly even a sneeze to make it do that. Over the coming months, we will be looking for compelling evidence that inflation is moving down, says Powell. We will make our decisions meeting by meeting. Really so I've been listening to, I have to say, I've been listening to News Squawk the past week, and I really like how they do things. It's like a really, I don't know how I put it. It's a very qualitative thing, but it's just when they speak, I feel like I understand what's going on more quickly. Like they're really good at knowing what to emphasize and the tone of his voice and things like that. Well, that was a good pushback here. There's still a ways to go below us before we're like they've been buying so hard today. They're well above any kind of market maker position, right? So 21.5 is kind of like the seller's break even point on the session. So that's still quite a ways below us, right? So just keep in mind that the larger overall trend in the treasuries is probably still up. I could probably I'm gonna take a gamble here with the sim trade, okay? I'll take 2 there. Take 1 off there. I might be able to give myself a little bit more room to breathe by doing that. Nope. Come on. No buy on that one. That's interesting. So I don't not necessarily liking that. Okay, they do buy it at 28, but not 28.5, huh? On that time, they're not stacking it. ES, really quite all over the place. So there was a ramp going into the open. Does look like, although like the very, very first move that came off, the cumulative delta in the end was positive off of that open. So So are they going to fall out of the bed here at 27? So ES currently kind of at the, okay, is this a pullback? Are we going to reverse or are we going to move higher? All US listed companies after the opening bell. Oh, it's just all red. They're all down overnight. Okay. That's what we were looking for. I don't know why it took them so long, why they messed around with it so much, because it only took them 96 contracts to make 28.5 go bid. So none of those offers stuck there. It does look like in the end, at the moment, that's more buyers than sellers, but I don't know. Okay, so that wasn't too bad. That wasn't too bad of a trade. It made me a little bit nervous. Oh, I did get 3 ticks adverse excursion on it, so wasn't perfect. Although, given the current circumstances, it's kind of hard to see not getting some adverse excursion on a trade, right? That's kind of why I'm a little wary about taking a trade over here in my live account. So this 116.30 is probably still a little bit of a hole that they might have some difficulty getting beyond. For the moment, they're kind of at the lower end of the range. So they're kind of chilling around the VWAP and even having some tests at 27. So that's why I felt that I could take that risk there. The order flow seemed to be in line with me. So that one was a good scalp. What they do from here, though, I don't know. I mean, it's entirely possible that now that the Powell's comments have come out that we're kind of negative, that they could try and push up here to the high. Just note, he's going to be giving his speech, per se, like his opening comments that have just been released to us, the market, because those are prepared ahead of time. So there's still going to be like all of this yammering with the politicians making their statements and stuff before they actually start asking him questions. So you're probably still going to see some volatility from him speaking, but not quite yet. it's going to be a while, can kind of lull you into a false sense of security. So just remember, he's going to be talking like all morning. Okay. ES is I don't know. So sometimes I'll see a move out of the corner of my eye and my brain just knows like, oh, that's not good. So I just kind of looked over there in ES and I was like, yeah, that didn't look good. But then when I look at the larger chart, like we are still up, so it's probably okay. It's probably okay, but I'm just getting a lot of like, hey, look at me kind of signals over here in ES. Wondering if I'm being a little oversensitive just because I didn't sleep very well last night and I feel a little more neurotic than normal. But ES is just like all over the place. Okay. So right there, one of the congressmen in his statements was urging the Fed to do something about stablecoins and cryptocurrencies because they pose a threat to the U.S. financial system. Who was that saying that? Is that a Democrat? I think that it would be a Democrat. I think that would be a Democrat. It bothers me that that some of the Republican politicians have been taking positive positions on cryptocurrencies. But it's kind of weird because the majority of cryptocurrency holders are Democrats. Look, they're making a good push up here. They're making a really good push up here. I guess I could have shorted at 17. I don't know. I definitely noted when it was at 17. I was like, and I was thinking about taking it, well, if I took a trade. But I don't think that I had a really strong opinion that we were going to move down. I think that I was kind of thinking, well, the trend is still up, so maybe I could sell 17. Does that really look very good? And then I look at where we're at, and I'm kind of like, don't know if that one's a good trade. But look, it's pushing really aggressively. And there was another rush up to the highs. Man. Okay. And how much volume was behind that? I don't know. I don't think I can explain those moves. The dollar is moving. The 6E is moving. That's what's driving that one. I think some of my charts kind of got screwed up. So I didn't have the dollar on this one over here. Let me add it again. Synthetic dollar index candles. 3 historical bars. Okay. So you can see they're kind of moving opposite to the dollar. And in lockstep with the 6J. So I keep hearing this headline about Putin making an order about how to handle certain payments and stuff. I don't know if that's moving them. What's the hill? Biden's approval ratings haven't recovered since last summer. Inflation is now sky high and worries are growing about a recession. It's left some Democrats questioning whether the party needs a different and younger leader in the next presidential race. Well, yes, but I think it also suggests that you need a different economic policy, guys, because your economic policy is clearly inflationary. Like, here's the thing. Republicans injected liquidity into the system too. Look, Republicans were 100% all in on buy all the things, okay? But while they were doing that, the whole time they were speaking against it, right? They were all saying this is a bad idea. Like, they're doing it, but then there was always politicians on the right that didn't like it, right? So the right was able to distance themselves from it. The Democrats, on the other hand, they weren't just like, oh yeah, we should totally pump up. Yeah, this is good. We should be doing this all the time. That is what the Democrats basically, that's what they were saying with modern monetary theory, right? Is we should be doing this all the time. Well, now, what are you seeing? This modern monetary theory nonsense does not work in practice because the markets do not react to those changes the way that modern monetary theorists think that they should. The bond market in particular really holds your feet to the fire, doesn't it? And this I think is a major problem for the Democrats. So you can change who's in charge, but they're going to have to do something different too. Right? You have to do something that you know your core base disagrees with. Okay, so S&P 500 still on the up move. I'm surprised I tell you what, the treasuries moved back up there to new highs so quickly. It was really quite startling to me. Gold didn't do that. Gold didn't do that. The 6J didn't do that. So I'm still kind of left at what is behind the strength in this bid. Seems off to me. Well, it's coming back down to 117. I wouldn't even be surprised if they come back to 116.30. But by the way, another thing I'm noticing, copper was going pretty good and it came back in a meaningful way as well. But the S&P 500 is mostly bullish. U.S. 10-year Treasury yields fall to 3.137, lowest since June 10th. What? No, where are they getting 137? No. Yeah, Papyrus IQ on Twitter. This is a guy we've been following for a while. I think we met on the stream once. Says 3.137. I don't know where he's getting that number from because the on the run is 1.16. It's actually kind of funny. Just them saying that made me kind of look at the curve here, and I'm only now just realizing how ridiculously inverted it is. Like, look, the 2-year is 3.115. Okay, so that one's still lower, but then the 5 is 3.22, and the 10 is 3.16. So it looks to me like that what's going on here is there's some real flight to safety risk, and that it's coming primarily into the 10-year, and so that's pushing the yields in the 10-year down more than the others, causing the inversion a little bit, because you've got like this huge notch in the curve, right? Wow. Why don't we just show it with the chart? Let's just make one of them charts. And do ZN. I do it day bars here. Indicators. Indicators. Yield curve. Which one is it? Oh, no, it's in the free one. Yield curve. Da, 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 da. Hopefully. It hasn't given me an error yet. I think it's still loading data. Oh, I have to put in the expiry. 09/22. Oh, it's not 09, it's 06. It's 6. Silly me. Risk off, yeah, it is. But why do you think it's a risk off all of a sudden, right? Okay. Now you can see it. Okay, so I'm gonna exaggerate this for you so that you can see it, okay? Do you see that? So the yield curve is indeed inverted. But why is it inverted? Because the 10-year is getting pushed down. So my theory, hold up here, just pull up the Treasury Analytics tool. It shows the complete yield. Yeah, it shows the bonds too, yeah. You know what? If I was getting that data here in NinjaTrader, I'd add that to it. No, I like my indicator, Ashk. It's an on-the-run curve. I love it. It's great. Okay. And I can resize it and stuff. But I say that this represents liquidity demand. The yield curve is inverted from liquidity demand in the 10-year Treasury. This is what's going on here. And why is that? Well, I mean, the curve is flat, no doubt, right? The curve is flat. But what's this notch? From liquidity demand. And I suspect that liquidity demand in the 10-year is actually from flight to safety risk. Now, here's a cool thing that we can do. Here's a cool thing that we can do with my tool. I'm going to bring this down a little bit. Is I can click over here and I can say, okay, what was it on June? Ah, do you see the difference? Do you see the difference before? So I just clicked on, yeah, that was, so this was like, let's just go one more day back. Okay. So do you see how it kind of changed? And then all of a sudden, see, like afterwards, it did this. Oh, that's so interesting. Am I picking the right ones? I need to add, oh, I did have something in there so that when you clicked, it told you which day you had clicked specifically. Maybe I should have it like listed over here. Should have it listed over here. But see, the curve was fairly flat before that inflation. And then what happened? Everything rose. The rates rose significantly, right? The rates rose significantly. And, oh, by the way, are we getting... Oh, okay, because it's showing me yesterday's. It's not showing me today's. That's why. Yeah. Anyways, the rates rose significantly, but then recession risks became much stronger. So then the flight to safety came into the 10-year and pushed it down. I think that's what happened. I think that's what happened. This tool still needs a little bit of work because what I would like to do right now, it just draws lines, right? What I would like to do is have all of the different versions of, you know, adjusting the curve just for fun, just as kind of an exercise, but an exercise for me. S&P 500 pushing up stronger. Wife's coming in. I have a puppy. Hello. Go see mom. There we go. All right. Why is the 3? Okay, so I don't have a 20-year on there. But my recollection is that there was something special about the 20-year. Do you remember that, Akshay? Like last time they had a 20-year auction, there was something about it that gave them a different incentive to want to hold it. And so that's why that one was kind of sticking out. I think like the curve overall is very flat. It's, you know, it's likely to be flat just because the risk premium for holding a 30-year just as it hasn't been very high. So it doesn't take very much for them to invert the curve, right? Doesn't take very much selling in the 5-year for the curve to invert. But I think that the big dip there in the 10-year is, I mean, it's often that you'll see a little bit of a bend there at the 10-year because of liquidity demand, but it's particularly exaggerated right now. And why is the 3-month inverted? Probably just because of the whole curve overall being pretty flat. I suppose it could be a bet that the Federal Reserve will not even get to. I mean, listen, with rates being at 3.16 right now and them selling, there's got to be some people out there betting that the Federal Reserve is going to back off before they even get close to their target rate, right? Nope, I don't remember. The only thing I remember is the mispriced the TWE. Yeah. Okay, so oh man, I wish I could remember what the deal was. It was like this little footnote on a zero hedge post that initially alerted me to it. But basically, let me see if I can remember here. The 20-year is treated differently at repo, is I think what it was. There's like some sort of extra incentive for the 20-year in the repo market. That's different from the other maturities. And that was causing the 20-year to behave differently, I think is what it was. Let's see if I can find a story verifying that. Oh, I can't read. I might have found the zero hedge. Well, let's see if I log in here. Yeah, probably I have to have premium access. Can't see the older articles anymore without premium access. So I can't see. I remember there was this one day where they had an auction. I think it was like there was a 10-year auction. Oh no, I think it was like there was a 20-year auction and it went really, really well. So everybody said, oh, okay, that must mean that the 10-year auction is going to be good too. Or at least I was thinking that. And then the 10-year auction was absolutely dismal. And everybody was like, why? And then the Zero Hedge's synopsis of the auction, they said, well, but the 20-year is special in repo and the 10-year is not. And that's why there was so much demand for the 20-year and it all dried up for the 10. But my recollection of it is very, very vague. But if it was something that you were really interested in, I think that would be enough that maybe a day's worth of searching Google, you could maybe find the answer. But I don't think that we figure it out here on stream. Oh, it's another 4 ticks up. They going for the highs again? Are they going for the highs again? It's kind of, I don't know. Well, the 30-year definitely moved up to the highs, didn't they? Oh, man. And all by themselves, too. Really, all by themselves. I don't know, guys. Something crazy is going on to me. The only thing that stands out about the 20-year for me is it's the only OTR that trades as cheapest to deliver as well. Oh, really? Is that true? Let's go look. It will open up Treasury Watch and the Treasury Analytics tool. $20-year. Well, there is a difference between the futures yield and the OTR yield, right? There's only 3 deliverables for it? How many deliverables? Look at this. That's how many different ones. There's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16 for the 10-year. And there's 3 for the 20. So there's just not very many. But you are right that, like, okay, so if I look at the Ultra 10, for instance, okay, so there's a 7 basis point difference between the OTR yield and the futures yield. And the futures yield is smaller. Whereas in the 20-year, okay, the difference is 1 basis point basically, and the OTR is cheaper. Yeah, it literally only has 3/4 in the basket, right? But if you come over here to the Treasury Watch tool here, and they do have somewhere in here, where is it? Oh, I thought they had a yield curve over here. Oh, here it is. It's over here. Futures yield curve. Ooh. I wish they had an OTR curve so I could see the difference. So I don't think that that's quite what the OTR curve is saying right now, is it? Is the Ultra 30 at 3.5? That's weird. How is the Ultra 30 at 3.5 and the 30-year on the run is at 3.24? CMT rates? Wait, what do you mean by that? Can you give me a link? Oh, I see. That one right there. Gotcha. Oh yeah, that curve looks more like what I think it should be. Yeah. Oh look, there's the 10-year taking another run there. I said to myself, why not just go short 3.15? But then I said, no, it's not. I don't know if it's worth the volatility and stuff. Look, I would have gotten $10, but then it would have come all the way back. I think I'd probably be a little frustrated if I was in a trade right now, even if I was the right direction, right? But that move higher was a little crazy. There must be some real unfortunate short covering going on here in the 10-year for it to be popping off like that over and over again. That's really like, I would say, the fourth time. There was one where it didn't get quite as high, but every time that it's moved higher, it's been like, okay, can I close this now? Yeah. Normally you get something like the treasury will go up and then come down, and then it'll slowly break a new high and go. But this one, it's been going, it's like spike, 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 right? It's doing this sort of thing. So it seems to me like somebody is like getting liquidated in waves. It's not really a consistent trend like it usually is in treasuries. It's a very strong pullbacks, and when it does accelerate to new highs, it does so very, very quickly. Now, when you look at the volume and the change in cumulative delta, it seems relatively consistent. But like the thing is like at some of these spikes, it was actually kind of flat. That like the cumulative delta was somewhat flat. So it kind of makes me wonder, like, oh, that should be driven by, that could be driven by some other asset somewhere, right? But then I look at all the correlations and I'm not seeing it. It's the treasury is going off on its own. So this is all just very odd action today in the treasury. I really don't like seeing a strong move like that and me not be making money from it, but it's kind of been like that a lot lately. Maybe a part of it is just me being behind the curve because I haven't been sleeping very well and the baby, and I've kind of been trying to be more careful with the risk anyways. But it seems like somebody else knows something that I don't here today. It could be just market driven. It could be like liquidations and stuff, but I really got an inkling for whatever reason that they're trading something else. That somebody is placing big trades on today based on something, and we won't find out about it until like a few days later, right? Heavy bid MBLs in the ZT. Yeah, ZN did go to new highs. It was only by like what, 2 ticks. Oh, 4, 5. Okay, so it was by 3 ticks, a new high by 3 ticks. But and again, it's like they'll go and they'll reach it and they'll come back very quickly. So like the thing that's frustrating about it, right, is normally if you're getting like a strong trend in the treasury like this, that's what you would typically tend to see, right? So even if you ended up getting in here like this pullback isn't very much. This is only like 4 to 6 ticks. You're fine, right? But what it's doing is it's doing ting, ting. So here, if you buy anywhere in through here, you get screwed, and it's coming back like 16 ticks, right? And so you and in here it's just flat. So really what you want to do is you want to catch it like right here. If you really like don't want to have to deal with adverse excursion or sitting in a dead position or anything like that, right? And the point to catch that one is like a split second, and then it's off to the races, right? She followed NASDAQ. Well, it could there is, I mean, it does look like the peaks between the ES and the treasuries have some degree of correlation, but it's kind of the opposite correlation that it usually is. It kind of feels to me like to some extent the S&P 500 is rising because they are less concerned about higher rates. You know what I mean? Another thing is I'm still concerned about the possibility that this comes all the way back to 30. That 30 might still be a bit of a magnet. They've also probably might start to dig a hole at 03 half would be another one. I guess I should also I'm sure that a lot of this movement could be impulsive trades based on what Chair Powell is saying right now. So for instance, right now they're talking about the Taylor rule. They're asking, well, the Taylor rule says that rates should be significantly higher. And he says, well, we've never actually used those rules to set policy in real time. So a lot of spot gamma goobers are going to stay long above 117 evens max pain trade. You think so? Was there some short gamma at 117? That could maybe make sense that every time it comes above here, you're getting a bunch of options hedgers buying it, and that combined with short covering is maybe why you get such a forceful move that then completely dies back. But that again, you know, it's a very interesting theory there, Octavius, because that again suggests that it has more to do with market positioning and dynamics than it does any kind of informational event, right? And that's what I keep debating with myself in my head here, is like, well, this could potentially be caused by some internal market dynamic, but it really feels to me like there's a significant piece of informational content out there that I'm missing. Of course, there's no way for me to conclusively prove a move is driven by informational content or not, unless I have that informational content and I can say, okay, they were timed together and the movement is in line with what we think the informational content should cause the market to do and all of those sorts of things, right? So when it doesn't happen, or when we don't have that kind of a correlation, we're stuck with saying either well, and again, like the market can move really strongly just on nothing, but I don't think that that's what's happening in this instance. Like I don't think that some large fund is repositioning or anything like that. I think that if you're getting non-fundamental flows, that they're more like short covering, etc. So it's like, well, it could be that, but it could also be informational content that we don't have access to, and only a few large players do. Why is it that I keep feeling like that's the case? I don't have any piece of information that I can point to that would tell me which it is. Probably by the end of the day, or maybe after a few days, probably we'll get enough headlines and information about what's been going on after the fact that we'll be able to piece it together, right? But at the moment, I'm just a little weirded out by the way it's moving, and that I feel like that there must be some informational content involved, right? But the gamma being a factor there, I think that probably could mean something. Like again, at this point, a lot of people went short after that CPI, right? So there's a lot of people that have been short through that CPI that might be getting stopped out of trades or taking it off a break even or whatever the deal is. I'm sure that plays a factor. And of course, can always be a small combination of a bunch of those things, right? But it's you know what's interesting about it to me as well. You know what's interesting about it is that when I say that there's something interesting about it, does it make you be like, I should pay attention here? Or is it like, Seth, he's just going off again? I don't know. Okay, but here's the crazy thing. We've had so much volatility in the market. Today's move is actually not quite as volatile as the moves last week. And yet to me, this move seems more significant. Do you agree with that? This move seems more significant than the other moves, even though those other moves were so much more volatile. I mean, like this move today, before I was kind of in the mode of, well, we really just want to go long rates until maybe they get to 3.5, 3.75, right? And now this move has me off of that. Now this move has me like, well, I'm not quite sure what their next step the rest of the week is going to be. It's the Powell boy. Yeah, well, yeah, that's another point. But I don't think that the problem is I'm listening to the news squawk. They're talking about what he's saying. I'm watching the Twitter. He's saying stuff, but he's not saying anything super significant to the market from what I can tell. Yeah. And the other thing here is that, again, the S&P 500 is buying up like crazy. Where are they relative to yesterday's levels now in ES? Okay, so they're not quite above yesterday's high, but they are darned close. Yesterday's high was 37.84. So we're about 5-6 points away from that. Where are we at? 70. Oh, okay, we're 10 points away from that. And look, the Treasury did come back to 116.30. Gap, and you go, always have to. Well, I don't know if that's one trade that I take. Have not found that to be a reliable. My spread candles indicator here doesn't seem to work correctly. There's still a problem with it. With my change. It's not the version that you guys have, but the new version that I made still seems to not work. Because there's no way that you got a gap in the candle that big. It must not be like updating every tick. Like it must be, let's see here, spread candle. Oh, it says calculate on each tick. Well, that's odd. Is suspended while inactive false. Well, that's weird. Unless it's a setting specific to this chart. On each tick, yeah. It's weird. I must have an error in my logic here. I'm gonna try and figure it out. See, that 30 is like a really huge hole, right? Okay, so hold on. I think I might have to go and drive the kid. I'll be right back. Let's see here. Welcome back. All right. CBOT is listing MBS futures in October? Really? Did you just get that email? Let's see if we got it. No, I got a broker tech recap. I got stuff from them. Mortgage-backed futures would be super interesting for sure. Okay, so are they, looks like, let's come back here. Let's get my bearings. So it looks like the S&P 500 continued their bull run to new highs here. Treasuries came off of their highs, but look like they're still positioned to make another move higher later. May not have actually made the decisive move today yet. So that is super, super interesting. Bitcoin also appears to be rising with equities. That'd be the end of the housing market. Oh, come on. What do you think about using AMP futures with Jigsaw for a demo account? That's probably just fine. So when it comes to your broker, the AMP futures are probably the cheapest. Okay. So the disadvantage of using the cheapest is that the support that you get is typically not as good. But generally speaking, you only need to talk to the support when something is bad, right? In an ideal world, you never have to talk to them. So most people, they're just fine with AMP futures and they don't seem to have any problems with them. And I really only moved away from them to get to NinjaTrader or to try other people, you know? So I think that you'd be perfectly happy over there. Only Freddie Mac and Fannie Mae issued bonds are delivery grades. Okay, well, it was the end of Bitcoin. Well, no, it's like, I think that the Bitcoin situation was a little bit different. Okay, so first of all, one of the main reasons that Bitcoin was rising at that time was because of the CME futures. Okay. Which was kind of really silly because when you really think about it, did the CME futures bring a whole lot more activity into the Bitcoin market? Not really, but if anything, it made it easier to go short. So there's that. And I think that making it easier to go short in the end was one of the things that killed the Bitcoin market, right? But the other thing is that Bitcoin has had Tether pumping it up this whole time, right? So just remember, there has never been a moment when Bitcoin was in a strong bull market that wasn't attended by strong manipulation from like money printing, essentially. Okay. Every time that it happened, that happened in the Mt. Gox crash, that happened in the 2017 crash, it's happening in the last 2 years. Okay. And in the 2017 and the last 2 years, it's both come from Tether. So if that's the case, then how do we explain the 2017 bear market? How did that come down so much if it was still being pumped? Well, apparently, long after the fact, we learned that a large degree of that selling was coming from the Mt. Gox well. So that explains why that was going on, right? So to say that the Bitcoin futures that somehow manipulates the market and causes that market to perform poorly or whatever the deal is absolute nonsense. Okay, the treasuries or sorry, futures. Let me start over again. The futures react to supply and demand. So the existence of the futures does not really have a significant effect on the treasury market supply and demand, and ergo will not change a darned thing. What broker? Well, I think that AMP is the cheapest. Yeah. So, I mean, there's a couple, and it kind of depends on what you want to do, right? If you're going for Jigsaw, then I think that your top picks are probably going to be either either AMP Futures, NinjaTrader if you're going to integrate it with NinjaTrader, or EdgeClear. EdgeClear is another choice that you got. But honestly, there's like a dozen. Like, here's the thing about it. Here's how I would approach it. There's like 20 different futures brokers out there, right? If you happen to develop a good relationship with one of them, you might as well leverage that relationship, okay? Because in the end, it's CQG and Rhythmic that really give you the market data. You know, like the difference between the brokers are things that I think most retail traders aren't going to notice. So like the relationship that you have with them is going to be a major factor, right? And that's kind of where I'm going with the AMP futures thing, right? AMP, you're going to have the poorest relationship with. It's not like they suck or anything like that. It's just like you're going to talk to a nondescript support guy, and then you're never going to hear his name again, and you might not always be happy with how well that support went, right? Whereas if you, for instance, you go to EdgeClear, you're going to remember names, they're going to remember you, and you're going to know stuff about each other. That's the difference. So is it worth paying a little bit extra in commissions for that? Up to you. But in the end, does it really affect your trading? As far as I know, everything that I've looked at, no, doesn't matter to your trading. So it's really kind of a personal decision, right? I probably should make a video about brokers, but like the thing is like say I made a video. Let's say I made a video about all of the different futures brokers, and I gave every futures broker the opportunity to like make their case for why you should use them as opposed to all of the other brokers, right? I think that all of those brokers would have a hard time. Like what would you say in that situation when you're like really being directly pitted against each other, right? I think that a lot of the reality is that it's very difficult to differentiate yourself as a futures broker outside of the software. And if you've already chosen which software you have, but that's kind of the cool thing is that you kind of have the advantage, right? You can go anywhere you want, especially if you become a successful trader. I tell you what, if you're a successful trader and you have not talked to your broker and tried to negotiate your commissions, like, dude, come on, because you have every advantage in that relationship. You think that housing isn't pumped, you're a rates trader? Come on. Well, okay, so the rates have been, let's say, influenced by certain government actions, yes. Okay. But that has nothing to do with what will happen when the futures come out for it, right? Of course, it kind of depends on what these futures look like, how they're structured and everything. But I don't know. It provides some players the ability to hedge, so that's good. But I think that the biggest change that we get from this is just that data on what mortgage rates are doing will be more available to us. What broker do you? Well, you just use the same one. Like again, there's no. Again, there's like, okay, there's let's go into more detail about this. I'm not trying to rag on you, but I don't think that you understand what I'm saying. Okay. There's you. Okay. And
you are sitting at a computer and you have Jigsaw, right? So that is your interface to the market. Now, what does Jigsaw connect to? Does Jigsaw connect to AMP? No, they do not. Jigsaw connects to Rhythmic or CQG. Okay. The Rhythmic and CQG get the market data from the exchange and send the orders. Okay. That's your data provider. So your data provider and your software choice are the two most significant choices that matter to you and how you trade and how your daily experience is. Okay. So where does the broker come into play here? Well, all of these trades have to be cleared and everything by a futures commissions merchant, an FCM. Okay. So that's going to be your FCMOs over here. Your FCM is kind of coordinates things between the data provider and the exchange in terms of like settling all of the trades. Okay. And then your FCM is connected to your actual broker. Okay. Oops. I misspelled broker. Broker. Okay. Now your broker may be, and your FCM may be the same entity, which is the case with AMP futures, but not always. They're kind of usually separate entities, right? Your broker. So what does this guy do? Because this is what you're really talking about when you're talking about AMP. What does this guy do? This guy is in charge of finding customers, dealing with the customer's problems when they have a problem, right? So what's going to happen is you're going to talk to the broker, and then the broker's going to be like, oh, okay, something happened here. We have to do something over here with the FCM. And like an extreme case where something really wrong, like oil just went negative or some shit like that, right? Otherwise, right, that's where it all comes down to. So in the larger scheme of things, does who you choose here matter? What the difference here is going to be with your broker is what your experience is going to be like when something goes wrong, right? Do you want to be talking to some nondescript support guy that may or may not be very good at his job when you call AMP? Because I've had both. I've had people at AMP that like really, really knew their shit, and I had people at AMP that seemed like they didn't have a fucking clue, right? Like the one that really drove me crazy was when the micro futures went live. And they're like, well, you can't trade that. I'm like, who's going to trade it if you're not letting us trade it? It's an instrument designed for retail traders. You're the largest retail trader broker. There's not going to be any volume in here unless you enable us to be able to trade micro futures. I had to have that argument with them, right? Okay, that's going to be your experience with AMP. Whereas if you go to, say, EdgeClear, for instance, there's going to be a guy over there that like was the person that recruited you or whatever, and you're going to have a relationship with them and you work with them. So you're going to get a support guy that like, and that is good, right? That's the difference. So is it a huge difference? Is it worth paying a higher commission for every trade for? Most people say no and they go with AMP. Okay. That's what it really does. CQG have more historic data? No, actually. So it kind of depends on what kind of historic data you're talking about. But when I try to backtest with historical bid-ask prices, my testing was better with Rhythmic than it was with CQG. It gave me more data and it appeared to be more in line with what actually happened. But it seems to me like the historical bid-ask prices are a little unreliable. Wouldn't base your trading strategy off of what a backtest says about historical bid-ask prices, right? CQG kind of sucks. I mean, so what's the difference between CQG and Rhythmic, right? I have a video about this, but for one, you do get a little bit better historical data through Rhythmic, at least in terms of like order flow data. Okay. CQG gives you access to indexes. So if you want to see how many stocks are rising versus how many stocks are falling at the current moment, you use CQG, you can pay extra money and you can get access to all of those different kind of indexes and stuff, right? Whereas Rhythmic, basically, you just get what the CME gives you, right? Rhythmic gives you all level 2 levels, gives you everything, whereas CQG only gives you 10. Okay, that's better. Big difference. Rhythmic allows you to use Rhythmic Trader Pro that can forward data to any C# program through memory. Like Rhythmic puts the data in memory, and then the other application pulls it out of memory. So I can be using Rhythmic Trader Pro and then have NinjaTrader and Jigsaw connected separately to Rhythmic Trader Pro. So if NinjaTrader crashes, it doesn't affect what's going on over here in Jigsaw. And I can use all of the features of Jigsaw and all of the features of NinjaTrader. Okay. So that's a big advantage too. Or for instance, if I made my own connection into Rhythmic, right? If I'd used Rhythmic API Plus and I wrote my own robot that runs in Python and is connected to it directly, right? I could do that as well. It'd be a little bit of a funky thing, but I think we could probably do it. I've had our trader errors where I can't close. Oh, really? That's weird. If you use a stack pull on your DOM CQG, well, no, I mean, it still shows you the stack and pull on the inside levels, right? Anyways, now live action says TT is better. Yeah, it is. It is, but you have to pay $100 to get the good version of TT, right? I should look into that more. I should ask them for another demo. Because with TT, the difference is you can actually do serious stuff, right? With TT, now you can try and get broker tech data and you can try and trade SOFR futures and like all sorts of way more complicated stuff. TT is way more expensive. Yeah, it is. No, I don't think it's I'm pretty sure that it's less than $200, if not $100. But I haven't looked in a while, and they kind of changed that. So this is something that drives me crazy. For a while, they showed what those prices were on TT's website. Last time I tried and looked, I couldn't see it. So I don't actually know what the details are. And I don't know like who, if I would actually give me access to broker tech data or what I would have to pay extra to get that. So I have to talk to them. And I might have to use a different, which broker I choose might change too based on that. But you're right, TT is probably the best market data. But then you're getting into an entirely different tier of stuff, right? Because you can get, so like, what are the options here? I got 10 minutes left here. So you can get kinetic data. Kinetic data is, I think they're a separate provider from CQG, but they're kind of associated with NinjaTrader too. But then you pay for like what you get like individually. So you can go and if you like pay for every little thing that they offer, and it can be like $500, right? You can use IQ Feed. IQ Feed is also good. You pay a little bit more, but it's really solid data, really high quality data. When I was using it, it looked better. But the problem I had with IQ Feed is that they had stuff built into the software that would hog the CPU. And so my other applications, in particular my streaming, would have hitches when I was using IQ Feed. Okay. And both of those are supposedly on par with TT data. So that's all I know about all that. I should talk to the trading technology. I don't know who's the social media outreach person for trading technologies now that Mr. I can't even remember his name now, huh? Is gone. I can't recall. But I should look into that. Patrick. Now that Patrick is gone, I wonder if they replaced him or if they're looking for somebody else to take his place. Now, the thing with trading technology, like the platform seems really good, but I don't like their DOM as much as Jigsaw. Seems like the Jigsaw, basically what Jigsaw did is we're going to take the TT DOM and make it better. So what is how I feel about that one. Feds Powell, we don't think we'll need to cause a recession. Yeah, and you never do. You never do. The rate of wage growth is not consistent with 2% inflation over time. Does that mean he thinks that in the longer run they'll still have a hard time be deflationary and that they'll have to pump money into it to get 2% inflation? Well, that reminds me of something I need to check on today in Utah politics. Oh my gosh, yes. So there's this politician here in Utah that I never liked. And when he was running for the other Senate district, there was this big battle between him and this other guy. This other guy was kind of the Trump supporter. So it was like the moderate Republicans versus the far right Republicans. And all of the far right Republicans said that the moderate Republican guy was a rhino, that he was really a Democrat and he was only running because he knew that he had never run as a Democrat, right? Well, Curtis won in the end, and in that election, and it was incredibly close, and it was very controversial. Well, yesterday, a video came out from Project Veritas, where they have a recording of him basically admitting that, yes, I am a rhino, and I really am a Democrat, and I only ran because there's no way that I would win an election in Utah as a Democrat, and that he has a position on abortion that is completely contrary to the voters of Utah. He doesn't like the laws that Utah has that if the Supreme Court invalidated abortion would instantly make abortion illegal in Utah and all that sort of stuff. So I'm interested to see if the local Utah news outlets carry the story about that, because that could be the end of Curtis there. Anyways, you don't care. That was a big change in subject, but I'm reminding myself about that. And I'm not talking about NinjaTrader Continuum because that's not CQG, but it is the same data basically, right? As far as I know, there is nothing different about CQG Continuum. It's just CQG branded for NinjaTrader users. There's not a difference. I've not noticed any difference between when I was doing straight CQG through AMP versus CQG Continuum through NinjaTrader right now. I've noticed a single difference. Treasuries are like just positioned there to be able to pop up to another new high at some point later today, I'm thinking. But no trades for me today. No clue why it's doing what it's doing. It was actually, so kind of interesting thing is that if you don't include, here, I'll show you over here on this chart. So here's my chart Treasury, right? So if you just include, like, since the stock market is opened, pretty tough trade, don't you think? Like, that's kind of like there's a slight uptrend to it, but it's kind of like you could really screw yourself over in this trade, right? It's only until you bring in the morning action that all of a sudden it's like, oh yeah, we're having a really strong uptrend today. So that's kind of interesting. Yeah, you compare them side by side and you say they're day and night. I don't know. Like the thing that's so difficult with data is that when it comes down to the quality of the data that you get itself, the orders coming in and the level 2 updates coming in, right? The difference between the two of them is very difficult to quantify, because you can't just look at it once and say this is what the difference is between them. You would have to take a huge data sample, and you would probably have to be able to compare it against the actual data at the exchange to say this one gets the updates before this one. Because, like, first of all, both of these get an order change. Let's say that a large order shows up at 117 even. Let's say a large bid shows up at 117 even. I can very easily come in and say, okay, this one received it at this time and this one received it at this time. Probably there will be like a 10 millisecond difference or something like that, right? Okay. But what if it's just a one lot? How do you know that this one lot was this one lot and vice versa? Because sometimes this one might come first and sometimes this one might come first. And without any way to correlate between the two of them and like what the order actually was on the exchange and everything, like it's hard to do that analysis in and of itself. Okay. So like a truly empirical comparison between data providers is, first of all, I'm not sure if we really have the tools to be able to do it. And then second of all, you would have to do it over a long period of time. You'd have to go and say, let's just say over this month, or really frankly over a whole year, how do they do better? Because maybe one might do better in this market and one might do better in this market, right? Okay. So then even if we do all of that, and we do conclusively show that there is a difference between the two data providers, how big is that difference? Is that difference really big enough to make a difference in your trading? I'm not sure it would, to be honest. Like, really, anything under 300 milliseconds, it's like the lag from your brain is a more significant factor in your trading, right? So it's kind of, I think what you're confusing about this is a continuum uses a microsecond snapshot of data. CQG is true tick by tick data, even when they are both CQG. Okay, what do you mean by true tick by tick data? So here's how the information comes into NinjaTrader. Here's a level 2. This is what the level 2 is at this price at this time, and that's all they give you, right? The only upgrade beyond that is market by order. I think you can get market by order with CQG now, right? But I think that you have to pay more for it. You can see how Denali and Rhythmic skip prices where a price pops into existence in prices. That might be something that you see in NQ that I might not notice, right? But like the thing is for me to come on stream and to say this data platform clearly has better data than the other data platform is even when it comes to IQ feed, right? It's, even if I can prove that one is better than the other, it's really hard for me to quantify it, and it's even harder for me to prove that one is that the difference is enough to make up for the price difference, right? Like, that's the big thing with IQ feed and Kinetic and all those is like, okay, but is it actually better enough that you're going to make $100 more a month to pay for it? That you'll make $100 more a month on average in your trading to pay for it? Not so sure. Seems to me like it's a pretty trivial factor in the larger scheme of things. Each trade, no, I don't think that what you're saying is accurate, SK. Actually, so I think I understand what you're saying. Can you show me some documentation that says that? Because that is not how I see things come in NinjaTrader. It doesn't aggregate them at all. What I see on NinjaTrader is every individual trade is just that the trades that I see are aggregated by the fills on the offer. So, which is why you have to do all the reconstruction and stuff. And on the level 2, those could be aggregated, but they all aggregate to some extent. They all filter to some extent. So, I don't know. How do you quantify what that difference makes in your trading? I don't know. That's why I focus much more on, hey, Rhythmic, you got Rhythmic Trader Plus, and you can forward it to all your programs. That's something that makes a big difference to you because that changes what software you can use, right? CQG, you can get indexes. That's something that matters because there are some technical traders that use that stuff in their trading, so it matters, right? That's something that I can say it really matters. So that's why I focus more on that when it comes to different data platforms, right? TT, supposedly, I can get access to other instruments that I can't get access to in Rhythmic and CQG. I think I need to investigate more in it, but that's something that would make a difference to your trading. That would allow you to pursue certain strategies that you can't do with Rhythmic and CQG, right? So small enough to not matter, but they're definitely, I would agree with that. Like, I can't conclusively, I feel that Rhythmic, generally speaking, is better than the kinetic data that I get here right now, but I can't really prove that that's really a thing and not just like my own perception of it, right? With TT data, there is like a real immediate difference. So I don't know what the deal is with that, but there's a real immediate difference with TT. It's like the TT data doesn't aggregate the trades as much or something. Okay. I gotta get going, guys. I will see you tomorrow. In the meantime, stay profitable, friends, or at least don't lose it all. We got jobs report tomorrow, so